Hello again. The performance of the greenback has been a bit like the weather here in London, absolutely miserable. So what's been behind the downturn in the US dollar over the last few months? Well, I've been speaking to Simon Smith from FxPro. I just want you to try and solve some of the problems I see with the US economy, which I don't quite understand at the moment. We have low consumer confidence, yet we have unemployment at multi-year lows. We also have a strong dollar, which in theory should help imports to the US. So why are we seeing consumer confidence so weak at the moment?
Number of factors. I think income, as we know, generally in the US and elsewhere, or real incomes, have certainly lagged what we'd expect. And it's only really the last sort of 2 or 3 months we've seen better earnings data within the employment report. So I think that's one of the factors that has happened. You'd have also thought with what's happened with energy prices in the broader picture of the fall, that would have given more of a boost than perhaps expected. So I think I think the income side is the main thing, that even though the job market has held up well in the US in comparison to others, in terms of the recovery we've seen, we've just about achieved a sort of pre-cycle peak in employment. But yeah, I think that it's the wages side of the really dragging down on the confidence.
So what about the inflation side of the picture? It's slightly more tricky when we talk about energy prices, because also the US is a big energy producer with its shale revolution. Net, these lower energy prices, is this beneficial for the US economy?
It's always a double-edged sword with energy prices. As we know, if prices are already low, you get deflationary risks if it goes through to the core rates. But I don't think that's the bigger risk here. Naturally, the issue for the US in terms of its own energy revolution is it's made a lot of that unprofitable, even though the recovery we've seen in oil. I think a lot of those projects that have been done on an assumption of an oil price much higher than it was here has caused bigger problems for the US, and that's one of the issues we've seen in terms of where the shale revolution is. Certainly the US wants to become more energy dependent, and that's great. But the oil prices naturally scuppered that, and there's certain pockets where that has certainly impacted on the employment situation, but it's much more sort of regional than on the sort of seeing it on the sort of global numbers.
Yeah, we do have cheaper petrol prices, gasoline prices, however you want to put it. Are you surprised we haven't seen more of a rebound in terms of consumer sentiment? Because is it just people like me who just want to see it now, or just have to be more patient?
Yeah, as I said before, I think with what we've seen in energy prices and the impact, because in the US it does tend to be much stronger. If you compare the US to, say, the UK or much of Europe, the tax wedge, as it's called, is much, much lower in the US, which they generally have weaker energy prices. They drive more, driving season and all that. So it does have a bigger impact in the US and a much more immediate impact than you see in Europe. So I think what we saw, for want of a better phrase, is probably sort of lag behind in terms of what we've seen in the energy price, in terms of confidence, but also what the impact that's had on growth, and especially in the first quarter, which was weak for a number of reasons. But that's actually been something we've seen the last few years. Sort of weak first quarter has been more the rule than the exception.
We've got the Fed minutes this week. What are you expecting Janet and Yen and friends to be saying in them?
Well, I think the general feeling is that they really don't want to be looking at tightening until they're confident that recovery is in train, that real wages are rising on a sustained basis, and there is no perceived deflationary threat. We've seen in elsewhere and beyond, the stock markets have, the steam has been taken out a little. We've seen some, reversal in bond prices as well, or sort of yields moving higher. I think in general they're probably less worried about the effects of low or continued near zero rates than perhaps they have been at other points in time. They've certainly done everything they can to prepare markets for the fact that rates are going to go up at some point, but I still think we're at the stage where they want to be as sure as they can be that any move won't have to be reversed, because that's always caused problems in history with Japan, with the ECB in recent years, in the US in the 30s as well, when central bankers put rates up and then suddenly within sort of a very short space of time has had to reverse it. It makes their policy levers much more weak.
What about the US dollar? A lot of the commentary that I've been reading, the analysts want it both ways. They're saying, we think the fundamentals are strong, but we also expect the US dollar to weaken in the short term. What's your take on where we stand with it? It's at roughly 3 month lows at the moment.
We are. We've from sort of end of the year, we're up nearly another 11% at the highs of 2014 on dollar. It's on 2015 on dollar index. We reversed about 70% of that move, so it has been a reversal longer than most expected. You know, with currencies, once you think something is an easy no-brainer, generally it then comes and bites you, you know, in the face quite abruptly. And I think that's been with the case of the dollar. We saw such an unprecedented move, sort of mid-July, early August, right up to sort of February, which in sort of floating exchange rate terms was, you know, pretty much unprecedented, especially when we didn't actually have an interest rate move on either side. You know, we just had the ECB moving to QE and the US having an intention to move rates. So I think it tells us, you know, currencies are never a one-way street, and I think that's why you've seen this reversal in the dollar go on longer than perhaps a lot expected. Personally, I still think it's to be quite a messy year, because with the US, you know, on paper not likely to, put rates up so far to the end of the year, in my view, at the earliest, that makes further headwinds or further upside for the dollar that quite tricky, especially beyond the highs we saw in February. On the converse side, you know, if we see in Europe, that's the other side of the coin. So since the sort of mid-April, when we saw the dollar index do its sort of not quite as high peak, the euro has actually been the currency which has, you know, outperformed the dollar versus the most, as we know, largely because of what we've seen in the huge reversal in bond yields. So bottom line, dollar will probably recover this year, but I don't see a massive recovery, just because I think the dynamics aren't going to, you know, favour another aggressive push higher. And what we're seeing in Europe, you know, the impact of QE, and that's the thing about QE. Yes, you think it's going to, they're buying bonds, it's going to push down yields, but actually, if QE starts to be successful, then the impact of that is actually changing interest rate expectations, changing inflation expectations, which pushes bond yields higher. So the ECB can also view what's happening with European bonds as, in part, a sign of the success of QE policy.
Well, thanks to Simon. There'll be more London Direct throughout the week, so stay tuned for that. But from a wet London, goodbye.